We now have a fabulous panel to explore what's actually really happening. So I would like to welcome back on stage Dave and Hamish. And I will be also joined by Michael Curry from Spendcodes, Nilixa Devlukia from PaymentSolve, and Eric Tack, head of the Digital Euro Division at the European Central Bank. Let's give them a big round of applause. Right. So without further ado, since we only have 30 minutes from this panel, and there's a lot to talk about, so I will start with you, Michael. So starting on the ground, obviously, where are stablecoin, in your opinion, actually quietly going live for merchant? And where are the old acquirers doing, and what are they doing?
Yeah, so I've heard that payments are solved today, largely for customers, and there's evidence to prove that's the case. But for merchants, not so much. In some countries, there's some serious issues with fees specifically, but more widespread, there's a number of countries that have had to go cashless on the back of the pandemic. And in that, they lose a little bit of control in their operation, right, is the general sentiment. So what we've found is that we're able to restore that with stablecoins and how they're uniquely designed. They fit really two excellent cases. First, they can solve these regressions from yesterday, like cash disappearing, and in the same time, be able to invite more innovations for tomorrow that help the merchants grow in their business. So a couple things that David touched on a little bit about some of the attributes that are great about stablecoins in their core. One is cost effectiveness, that's great. Fast settlement, also great, kind of sets the table. But the thing that's kind of not known yet, but will be a big presence in the future, is the impact they make on programmability, right? This is their strongest asset, and this will actually get even better with more AI, with more developers, with more customers adopting it as time goes on. So cutting that away, if I just cut you a simple case, right? So a merchant today accepts digital cash. They have this money on hand. They can turn around and they can pay vendors directly, right, with accounting under their control. This is certainly attractive and quietly getting traction. But at the same time, what's interesting on the other side of the transaction is apps are starting to issue stablecoin wallets to all of their users. Some of the biggest announcements recently were Cash App announcing they're going to give stablecoin wallets to 58 million users, shortly followed by Meta, who's giving 3 billion stablecoin wallets to all of their users worldwide across their app portfolio. So what's really interesting about this is those are compelling numbers, but the most interesting part is the implementation, right? So for a lot of us who have talked about stablecoins for quite some time, we have this concept that stablecoins are like a token to be used in a casino. You can't actually use them until you get them. That's all changed. App developers see stablecoins as a new medium for dollar innovation, which changes a dynamic that's really important, right? The dynamic is customers will continue to choose apps like they have for the last 20 years. But going forward, app developers are choosing stablecoins on behalf of their users for these market opportunities. And this is all exciting and happening really fast. Most of those apps, including our service, are scheduled for second half 2026 general availability. So we expect more AI, more fintech, more neobanks, and more banks to participate and follow this practice, right? Really giving some excitement for this market and merchants.
And that goes back to the point that Hamish was making earlier on in terms of acceptance being a fundamental pillar. And I'd like to go back to you, Hamish, just now. You mentioned briefly in your presentation where stablecoins are actually being used and where people can actually derive real benefits and where they don't. Could you please expand a bit further on that so that we're all clear of where value is actually derived?
Yeah, I think value is definitely in B2B when it comes to stablecoins. It's unmatched. I don't understand really, if you're live in the emerging markets, why you'd want to be settled in fiat anymore. There's no need to be dependent on intermediaries and the traditional banking system. B2B treasury solutions, if you're pre-funding as well, like it's 24/7, it's over the weekend. It's kind of ridiculous that I can be on calls with my boss in Uruguay for 5 days of the week and there's no fees, but when it comes to sending a transaction, it takes 4 days to do it. It doesn't make any sense. So on the B2B side, I think it's clear. The retail payments piece, I don't think stablecoins are going to replace systems like UPI and PIX. There's 160 million people using PIX in Brazil, and it's instant and it's pretty cheap. So there's not really a massive use case there. What I think is it's going to be a bit of a perfect harmony, or a bit of a healthy marriage where they can work together, and you can have stablecoins at checkout. But I don't see it actually replacing the kind of fiat financial system until everyone is holding stablecoins, which who knows how long that'll take. But when it comes to B2B transactions, that's where the magic happens.
Absolutely, and when looking at the sort of B2B transaction and the wholesale and treasury plumbing, going back to you, Dave, what's genuinely new this time, and what just feels like something we've seen before, and a new story with a shiny coin?
I read news stories about stablecoins all the time. I mean, my favourite story was, I don't know if you have a favourite story about stablecoins. That's a bit perverted. But my favourite story about stablecoins last week was the guy who accidentally sent $50 million into oblivion, which is why I'm a bit sceptical about stablecoins in the mass market. I see it as more of an institutional thing. It sounds like a good thing, like give people a wallet, put them in charge of their stablecoins. But if you do that, you have to remember the amount of scamming, fraud, and criminal behavior that's going to sit on the back of that will be astronomical. It's bad enough as it is with APP fraud. So the idea that people... it's one of the things that I think sounds good on a conference stage, but when 3 billion people have got Facebook wallets, 2 billion of those are going to have all of their money stolen by, they're going to click on the wrong link in a thing, or they're going to download some malware or whatever. So to me, I see it much more at the kind of institutional level. I don't want to be my own bank. I want Barclays to be my own bank. And if things go wrong, I want it to be Barclays' problem, not my problem. Now, if Barclays find it more efficient, which I'm sure they will, by the way, to use stable coins instead of messing around on existing bank rails, that's great. But I'm not sure as a consumer. In fact, I sort of think as a consumer, payments are quite boring, to normal people, not to these people. But like when you walk out the store and put your thumb on it, in your heart of hearts, do you really care if it's an 8583 pull or a 222 push or some kind of weird digital euro thing that we may have in a few years' time, who knows, or some kind of stable? Like, I think as a normal person, you wouldn't care. So I just don't see it as a consumer thing. I see it as an institutional thing.
Quickly, I agree. The difference is app developers are choosing stablecoins as the settlement. Customers just look at it as dollars to use in the application, which give them a lot of guardrails that they're used to from traditional point-of-sale applications and things that they're using in-store right now.
Yeah, and consumers largely don't care. In fact, both Dave and Hamish mentioned guardrails and regulations in both of their talks, and as soon as something starts working, then suddenly we need to put guardrails around it because new fraud happens, and we need to instill, so to speak, stability in the system. So our second question is around that. So some may describe regulatory frameworks such as MiCA, for example, as a regulatory shock in Europe, and arguably that it may have shrunk the field, but arguably also raised the quality bar. So I'd like to first start with Eric. So when you look at MiCA-regulated stablecoins in this context, next to, for example, the digital euro, do you see them as a useful complement inside the payment ecosystem in Europe, or something that will always sit at the edges of real money?
Well, that all remains to be seen. We'll probably touch on digital euro a bit later as well. Personally, I'm still a bit on the fence to see how this develops. I can see how maybe Barclays may think that stablecoins are more efficient, but they also have a vested interest in a business in which they earn a lot of money today on SWIFT and FX margins, which may make them less keen or less likely to be the first mover into more efficient rails. So if there's some competition there, that will probably be right. At the same time, we see that for a lot of use cases, as long as you stay in stablecoins, it's very fast and cheap. But if you still need to pay your suppliers in fiat money, you have off-ramp costs, you have still an FX charge somewhere. So once it would be ubiquitous for all use cases, you can keep using these parallel rails to fiat money, and it would make sense. If you you still have to move in and out of stable coins for this quick leg across the border. I'm not sure how that all stacks up. I think the comparison was interesting on cost and fees, but it kind of skims over the on and off-ramp fees, which can sometimes also be substantial. And we see Swift working on things which look more like a faster horse than building a car. So they're actually accelerating the processes they already have to at least make it intraday, but they will never get to that to the levels that we have in Europe here on instant payments or anything like that. And then that can still remain a dominant rails if banks finally understand that they will have to give up their FX margins on there, because that's what's gonna kill them. So if there is a demand, surely at the European Central Bank we want to make sure that not a whole new parallel system only reliant or denominated in US dollars comes about, and we want to make sure that it's that there's also alternatives in euro denominated available for monetary policy reasons. And that brings interesting questions as well, because apart from the fact that we say the token owner should be protected under MiCA, so it's still bank issued in the current system, we also need to see what the effect is if it really takes off. Currently, the largest stable coins own as much as 2% of the short-term treasuries in the US, which is actually, the American government doesn't mind, because it actually lowers the cost for government debt, which is in their favor. But they start to be really big players on the repo market as well. So we have to see what the effects are going there. And then secondly, we need to see what happens, because when we originally shared the plans for the digital euro, the bank said it's going to be a nightmare because our balance sheet will be affected, retail funding will be gone. Suddenly, these same banks are actually into stable coins, or tokenized deposits, which will do the same. When first that was going to endanger lending to companies and SMEs in the economy. So that's where we want to see what happens. But certainly, if there is a genuine and legitimate and ongoing demand, we should make sure that there's also euro-denominated initiatives, which we're glad to see happening now, at least 2 big initiatives from consortia.
Absolutely, thank you, Eric. So now to you, Nilixa, on the ground. So what are the regulatory regimes, such as the EU regime and the UK regime? What is their effect on the ecosystem as a whole? Shrinking, promoting, pouring fuel on the fire?
Well, let's park the UK regime for the time being, because it's not actually in effect. Obviously, MiCA, the initial basis of MiCA was to apply a brake. It was a direct result of what was happening in the market with, what was it, Libra, was it the final name it started as? I can't remember which way around it was. But obviously what we have seen is that MiCA has provided a regulatory framework to bring stable coins more into the mainstream. It's not without its challenges, but we have to remember that regulators regulate because there's either a concern, there's a risk, or because they want to provide an ecosystem in which something can thrive. And I think at the moment, MiCA is framed from the point of concern, but I think that Europe is looking forward and thinking, actually, where is stablecoin going to be within our ecosystem? Because we will have, for a long time still, we're going to have cash, we're going to have deposits, we're going to have stable coins. My view, we'll have a digital euro. These are all going to exist. So the question is going to be, who can participate in these ecosystems, who's going to have access to them, and what use cases are they actually going to fulfill? What's the end need here? If you have a digital euro stable, if you have a digital euro stablecoin, yes, I am meaning a digital euro stablecoin, sorry, then it's got to be accepted. You know, I mean, this is the thing, is that Europe is not set up right now in any meaningful way to have acceptance at point of sale. That's going to be a key factor that needs to actually be implemented and grow. Now, the question is regulation going to just be agnostic on it? Is it going to support it? And I think these are the questions that are going to have to be answered as we move along. The UK, as far as stablecoin regulation is concerned, is actually still thinking about it. It's thinking that it would align it to payment services regulations, which makes a lot of practical sense if you take the view that stablecoins are for payments and not as a reserve or value. But again, we wait and see what that's going to look like and what the actual parameters of that's going to be, because one of the biggest challenges is not whether you're in or out of the regulatory perimeter, is what are the capital requirements, you know, what are the authorization obligations, what are the threshold conditions you actually have to meet to come and play in the ecosystem. And I think the other point to note is obviously there are, as Eric mentioned, there are a consortium of banks. There is already a bank-issued stablecoin in Europe. It's just done under a different entity name. So banks are looking at this space and looking at how they can participate, and they're only going to do that if they see value in it.
Yeah, thank you, Nilixa. So very briefly, I want to go back to Hamish, because I'm interested in your take as far as the various regulatory regimes' effect on the markets that you're servicing, you know, breaks or promoting quality, stability.
Yeah, I mean, we play in a different playground. I mean, emerging markets is completely different to Europe. I think they can both act as a brake and an accelerator. It really depends on how well drawn up they are. I think MiCA was a good example of it. Now it's in place. People know how it works. I would classify it as an accelerator. It's clear we're now seeing adoption by tier one players, but working in emerging markets, one of the challenges that we see is just poorly written regulation. They might mention something very briefly about stablecoins, one or two lines that 5 different law firms have different opinions on what it means. So it really depends on how well drawn up it is. So yeah, clear regulation is definitely an accelerator. Unclear and grey regulation is just going to be a blocker. You're never going to get, you know, tier one merchants making meaningful treasury moves if there's not a clear regulation in place.
Absolutely. So we've briefly explored regulations in this context. We can talk about this much more, but regulation is one thing, design is another thing. So let's zoom out of that and go from rules to architecture and look at how public and private money can actually fit together. And I'd like to go back to Eric on that front. So from where you sit, Eric, are CBDCs and regulated stablecoin really on a collision course, or are you already designing a two-tier model where each has a clearly defined job in the ecosystem?
Well, we've always had, no. I mean, as you've seen in Dave's presentations, we've for a very long time had a two-tier system when there's central bank money, commercial bank money, and even non-bank money circulating, so maybe a three-tier system. We've had that for retail payments as well, but I don't really see I think the use cases and the benefits that you could see in stablecoins are completely different than from a central bank digital currency. So for us, central bank digital currency and the digital euro is completely about bringing the benefits of cash into the digital age. Maybe a bit belated because the digital age has started a bit back, and maybe central banks are not always the fastest to catch on. But we just want to make sure that things like the cash-like privacy that we have in cash is still available in a digital form as well, much as the resilience that it provides in case card systems don't work, the monetary anchor function, the fact that it's something which is available for everyone and accepted anywhere. On top of that, the sovereignty factor, which and making it deliberately non-programmable, for instance, which would be one of the benefits of a stablecoin that's issued. So for us, it's really, well, first of all, we won't be issuing stablecoins ourselves. At least there's no plans for that. But we see it as mostly complementary.
Sure. So to follow on from that, I'd like to come to you, Nilixa, and looking at the sort of the legal angle. And is this going to promote or crowd out innovation? I mean, what's your take on all of this?
I don't think central banks issuing or not issuing a stablecoin is going to crowd out innovation. Apologies for that, Eric, but innovation is happening across the board as we speak. It's going to continue to happen. Today, most of it's happening in the unregulated space, And what happens is that as it grows, when we talk about payments, as it grows, as uptake increases, then this is where, as I said before, regulators think, do we need to bring it into the regulatory space? Are we happy with how, mainly it's a consumer protection thing, but obviously businesses are interacting as well. Are we happy with what people understand is the payment mechanism that they're using? Are we happy with the protections that apply in this payment mechanism? And therefore, do we need to do something about it? Digital euro is, as it stands today under the regulatory framework, going to be treated as a payment service. So we already have legislation in the EU about how payment services function. You know, there are ongoing considerations as to who will have access in order to distribute a digital euro. We know where the current legislation sits. It remains to be seen if it is as open to everybody as anticipated. But I think that there are also other considerations if you think about how digital euro is going to work in a payment services space, because we have payment services legislation that also covers open banking. So will digital euro wallets be accessible for open banking payments? I mean, this is an unanswered question, an important one for many who are attending this conference. So I don't think that public innovation is crowding out or going to stop private innovation. They're going to coexist. And actually, one would hope that public innovation is learning from private innovation. You know, Eric mentioned the key factor of privacy. That's equally important when you talk about programmable money. We all talk about privacy, we all have concerns about privacy, but today when my payment flows to Hamish at the end, that payment has data that flows with it. I'm truly not concerned about that privacy. I don't think about it. But actually, if there's a smart wrapper contract around that, say it's because it's got my house purchase details in it, then I'm probably going to be a bit more concerned about the privacy angle of that and how it's accessible. And I think that the conversations, therefore, apply both to private and the public space. These concepts of privacy, security, they're equally applicable across both ecosystems.
And absolutely, which actually leads us on neatly to the risk and resilience aspect of all of this. So going back to you again, Eric. Sorry, having the European Central Bank on the panel is just too much of a treat. So if you look at the next few years, as far as you're concerned, so which stablecoin stress scenario would you actually make this financial stability problem for you, rather than just a product incident?
I think we, well, like anything on regulation, we usually have regulation once we've seen which problems can emerge, and we hope that they first emerge on the small scale so we can prevent them on a large scale. I think there's a lot of interest also on the BIS side, the Bank of International Settlements, particularly to look at multi-currency, multi-issuer stablecoins, to see if any of the reserves that are used to back it up on the euro side could ever be flowing out to have to back up problems elsewhere in the other currency leg, for instance. But I don't think that for us, and anyway, we're not the legislator, we're not the ones behind the MiCA regulation either. That's parties in Brussels, the co-legislators that deal with that. Our main focus is on making sure that if there is a legitimate demand, which there seems to be for stablecoins, that we want to promote the fact that there's European and EU and also euro-denominated ones available, but also to encourage, and that's what we're doing, for instance, on digital euro as well, at significant expense, for instance, also for the privacy issue and the resilience issue, we've deliberately chosen to host our solutions not on US-owned or US-based cloud services, the big hyperscalers, which are basically 95% of the market currently, but saying, no, we want European suppliers that are European-owned, and in that way also creating a market for those kind of services in Europe. So I think it's part of a bigger initiative where we try to eat our own dog food as well, on becoming less dependent on parties we cannot control, that are not necessarily as trustworthy as we believe them to be, and making sure that we become more sovereign and resilient in that respect.
Absolutely. So on the ground, Michael, what would you say to merchants? How would you advise them in terms of the minimum risk safety net, so to speak?
Yeah, so there's merchants in market already that are taking many tokens on many networks, which is, I get it, there's like no fees for blockchain transactions, so that's why it's attractive. The risk you run in that whole scenario is that it's operationally really complex. So there's a couple recommendations that I personally have for merchants when they approach this sort of opportunity. Is first, just lock in and focus on regulated stablecoins. There's two reasons why. It's familiar to folks as far as value, and there's also consolidated liquidity. The US Department of Treasury believes that it's going to be 10x in 2028 to a $2 trillion number. So that's already a pretty good start if you're thinking about just the opportunity of what's ahead, right? Additionally, you're going to look for what does my POS allow for integration. A lot of people are not going to have this option based on either time or cost or not just having an option available on your POS. It's perfectly fine. There's a great solution out there, soft POS, soft POS. Europe's been a leader here for years, right? And there's a number of reasons why. They're ubiquitous, they're affordable, but their best asset is they allow you to distribute without disruption to your other payment methods, right? You can have a universe where you have two apps on the same device where you can essentially download to upgrade your entire system and everyone knows how to use it. So this gives a lot of control back to operators at large organizations and even single store merchants.
Thank you. So very briefly, back to you, Nilixa, because I really want to get to the last question after this one. So in your opinion, so what would be, if you had to write the minimum viable toolkit for stablecoin resilience, what would you advise to prioritize?
That's a really good question. For stablecoin resilience, well, obviously, the things that you want if something goes wrong is that you can get your money back. And therefore, as far as stablecoins are concerned, it's how the reserve is managed, you know, what scrutiny is applied to that reserve to ensure that the asset quantum is correct, and then also what's the mechanism for returning it to end users. You know, what's the resolution and recovery planning for stablecoin issuers? And I think those are the two main things that have to be focused on in order to, I mean, everything else works well, but at the end of the day, it's when it doesn't work well that you actually have to plan for and make sure that the protections you have put in place actually apply. And the one thing that, you know, whether a bank goes under or a payment service provider goes under or an e-money provider goes over, the one main perspective of consumer protection is, are you going to get your money back?
I think to a horrible nerd like me, you people are being really annoying because you're using the words stablecoin, central bank digital currency, tokenized deposit, deposit token, digital. You're using these kind of interchangeably. And they're really not the same thing at all. A central bank digital currency is not and will never be the same thing as a stablecoin. A central bank digital currency has social goals. I mean, the reason for having a central bank digital currency is to increase the net welfare. It's to do, you know, something to make things better for the sort of, like stablecoins, they don't have that kind of goal. It's apples and oranges. They're not going to converge. They're completely different things. And the idea that, I mean, there was a very good quote in the Financial, I'm embarrassed, I've forgotten the guy's name, but there's a guy in the Financial Times who said, there's nothing inherently dodgy about stablecoins, which is true, but there is something inherently dodgy about banking, which is also true, which is why you need really, really rigorous, strong regulation about anything that involves the creation of credit, which is what blows things up. But actually, you don't need that for stablecoins. Like, the innovation would come from having, and you've seen this in the US with the first skinny account being given. So I just, you know, these things are all very different things, and I think we should develop different strategies for each of them. I don't think we can have like a crypto strategy or you know what I mean? It just bothers me. These things are all really different, and we should be talking about them in very different ways, you know?
Absolutely agree, and I'm afraid that's all we have time for. So I'd like to get to my last question, so I'm going to ask all my panelists to be very brave and very fast, because we're nearly out of time. So here's the question. It is now MPE 2029. Give me one headline you hope we're talking about when it comes to stablecoins in a single line. Please, starting with you, Hamish.
Okay.
I don't think we will be talking about stablecoins by then. I think you mentioned it earlier in your panel. It doesn't really matter. I think it will just be a part of payments. It'll be a part of the plumbing. No one talks about how you send an email anymore. It should be like that. That's the fundamentals. Yeah.
Michael.
Piggybacking off that, the top 100 mobile apps in fintech, AI, et cetera, that work for in-store payments and help merchants, yeah, that's what I hope is going to happen.
Eric.
Yeah, for me, the absence of a headline maybe, that it's just taken its place, whatever that place is, without creating too much noise.
Fantastic. Dave?
It'll be something to do with brand. It'll be like Kardashian coin, now the #1 global currency or something like that.
Nilixa.
Stablecoins have scaled without breaking the ecosystem they're looking to improve.
Fantastic. That's all we have time for, I'm afraid. Thank you very much to all our panelists. You've been fantastic. Thank you for being here.